I hope you all be fine. Today we are going to start the very basic approach of accounting, the accounting cycle, which is the basic process. Before the accounting cycle, I have discussed the different principles of accounting, the nature of businesses, the different types of corporations, the transaction approaches, the double entry system, the single entry system, right? The cash basis approach, the accrual basis approach, which really will play a vital role towards building your concepts, toward building your mind, like how to understand the basic processes of accounting cycle. So the today's lecture is about the accounting cycle, right? And to discuss the basic steps in the accounting cycle. The steps in the accounting cycle are one by one will be discussed. First of all, before starting the accounting cycle, you should analyze your source documents and then record your business transactions in a journal. Right? Before going into the details, I would like to give you a brief overview of the source documents and also to give you an overview of the journal, like what is journal, like where from the journal derived. Accounting equation was very much simple, in which you will simply record the transactions, the financial transactions or the economic events of your business in a very simple format, like asset is equal to liabilities plus owner's equity. But this equation was incomplete. How? Because the revenues and expenses were very separately be dealt in the accounting equation, only with cash and capital, without the proper formulation and without the proper income statement development. Here the journal or the accounting cycle is the proper cycle that will capture all the financial transactions in a very sophisticated and organized manner, then step by step transferring the transactions from one place to another and from one statement to the other in order to give a very summarized and very sophisticated overview of the business data. The source documents, here I would like to talk about the source documents. The source documents are also called your evidential proofs. Evidential proofs of the financial transactions are the invoices, the bills, the receipts, the cash memorandums, and other evidential proofs which are necessary to analyze a business transaction. So before recording a transaction, the accountant, the manager, or the bookkeeper, he must collect the source documents in order to properly record the business transaction with a proper reference. Where you will be recording this business transaction? The business transactions are to be recorded in a journal. A journal is derived from a French word jour, J-O-U-R, jour, which means to record your financial events in a very chronological order, date wise. On daily basis these statements are to be updated, and that's why it is called journal. A journal is also called a day book. It means that on daily basis you would be required to record your business transactions. For a small business, the transaction limit might be very small, but for a big business, for a big multinational company, or for a big corporation, the number of transactions would be very high, right? And before the journal, I also discussed the accrual and cash basis of accounting. So normally businesses will be adopting the accrual basis of transactions so that they may record the credit transactions as well as the cash transactions in a statement. So this journal is called a general journal, where you will be recording different transactions of different natures in a mixed nature. Second, post journal entries to the ledger accounts. If you remember the definition of accounting, where we discussed the accounting definition and we correlated the relationship of the accounting definition with the different practices. So journal is the recording phase and the ledger is the classification phase. You will classify the different accounts in a proper statement called the ledger accounts. The classified representation of all the business account is called as your ledger. Preparation of the trial balance. Trial balance is another statement. In the accounting cycle, these three steps are very important, because in these three steps you will be properly in a system of very summarized form. The business transactions are to be recorded. So the preparation of the trial balance is the summarization phase. So you would be dealing with relevance to the accounting definition. You would be dealing with recording, classifying and summarizing. This is the summarization phase of the trial balance, where you would be representing the balances taken from your ledger accounts, right? All these can be covered in chapter 3, but the onward chapters that are coming in, that is gather adjustment data and record adjustments in the worksheet, right? Your further chapters, your further lectures will cover the adjustments or the adjusting entries. After the trial balance is prepared, quite possible you might have some accounts whose effect is divided over a number of periods or over a number of accounting periods, right? So the adjustments are normally made for those accounts whose effect is divided over a number of periods, right? Or sometimes we forget some accounts, or some spontaneous accounts are there existing in the business, which from the passage of time or which from the consumption, automatically they create the side accounts for which your adjustments are necessary. So every account has to be adjusted at the end of the month, right? And that's why adjusting entries are passed for those accounts whose effect is divided over some time span. And a worksheet, which is a very analytical statement that you will be dealing in chapter number 4 of your recommended book. Worksheet is a very simple and summarized analytical statement used for the purpose of accountants and accounts managers, so that they may have the overall impact of the business transactions and the business data on one sheet, right? They have different columns in the worksheet, and in different columns they have the old trial balance, the adjusted trial balance, the income statement and the balance sheet. Total 5 columns are there, right? And this statement is prepared in order to know about the exact status of the business. So the worksheet plays a vital role in the proper analysis of your business transactions. Complete the worksheet. After the worksheet is completed, right, the difference of the income statement must be equal to the difference of the balance sheet in order to properly complete the worksheet. After the worksheet, create financial reports from the data in worksheet. The worksheet helps the managers, the accountants, the bookkeepers to prepare the financial reports, and these financial information are prepared in the form of income statement and balance sheet for the users of accounting. Who are the users of accounting? The users of accounting, they are the creditors, they are the managers, they are the employees, the general public, the income tax authorities, the investors and other relevant general public who are very much interested in your financial data. Even banks are interested in your financial data at the time of any loan grant. Journalize and post the adjusting entries. That is to be covered in chapter number 4. And journalize and post the closing entries, which is the last step in the accounting cycle, right? So the second last and the last step is the preparation of the post closing trial balance. That is to be covered in your chapter 5. Look at this diagrammatical representation of the whole accounting cycle, right? Analyze the events, classification, valuation and time, right? Then the classification, evaluation and the time span can be obtained from the documents of your business transactions, the source documents. Definitely the source documents are important to give you the proper classification of the transactions, to value a transaction in monetary terms. Every transaction is to be valued in monetary terms, because by definition, a transaction is a statement, a business activity, an economical activity that can be represented in terms of money. So money is the measuring rod through which you value a business transaction. Recurring activity during an accounting period, for example, for months, for quarters, for years, etc. To start the process, look at step number 2. Record the transactions. Record the transaction means journalize. The journalizing is the second step to properly post a transaction into the daybook in a chronological order, right? Properly, date wise, with a proper description. Then the third step is to post the accounts. Posting is basically the act of transferring accounts balances, business accounts, in a statement called ledger account. So these ledger accounts are prepared for summarization purposes, for classification purposes, and every business account is classified in order to know about the exact balance. Fourth step is preparation of the trial balance. But here at the right side you can see the worksheet, which is an optional statement for the bookkeeper, for the accountant, for the person dealing with the accounts, which communicate the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. Right? Step number 5, record adjusting entries, journalize and post. Adjustments are necessary because if you are forgetting some accounts, or in other words, if some accounts have the impact divided over some other number of years, then adjustments are necessary. After adjusting entries, an adjusted trial balance is prepared, right? And after the adjusted trial balance, then further financial statements, income statement, balance sheet, statement of owner's equity, statement of retained earning, etc. will be prepared. In step number 8, record the closing entries. Again, this process again will be started because there are nominal accounts which are used to be closed down, and the permanent accounts, right, they are to be represented in balance sheet. With reference to the closing entries, journalizing the closing entries and posting them to the ledger, with reference to it, I would like to give you some brief information. Why we are recording the closing entries? Your accounts are normally divided into 3 categories: the real accounts, the nominal accounts, and the personal accounts. According to the British approach, your real accounts are the accounts of your assets and liabilities. Your nominal accounts are the accounts of revenues and expenses, while the personal accounts are the capital accounts. So real accounts and personal accounts are to be kept permanent accounts, and the nominal accounts, revenues and expenses, are merged and closed, right, to a very common account called income summary account, right? In step number 9, we prepare post-closing trial balance, where we can only be representing the real accounts and the personal accounts. Now ready to begin the cycle again. In the next accounting period, the temporary accounts have 0 balances, they are closed, and in next accounting period, you will be starting your new accounting balance. Before recording the transactions, the rules of debit and credit are necessary to understand, right? The 5 building blocks of accounting, which are assets, liabilities, owner's equity, revenues, and expenses. Assets is equal to liabilities. Look at the sequence. Assets is equal to liabilities plus owner's equity, and revenues minus expenses is equal to either profit or loss. But look at the ups and down, increase and decrease in terms of debit and credit, right? What comes in debit, what goes out credit, right? But with American approach, the asset accounts, you can see at the time of increase, all asset accounts, whether current assets, whether fixed assets, they are debited, and all the asset accounts at the time of decrease, they are credited. Look at the liabilities. In the same manner, liabilities at the time of decrease would be debited, at the time of increase will be credited. Same like the case would be with owner's equity or capital. At the time of decrease, capital accounts are debited, at the time of increase, capital accounts are credited. Revenues at the time of increase are debited, at the time of decrease are debited, and at the time of increase are credited. And expenses at the time of increase debited, at the time of decrease credited. The rules of debit and credit are really pretty easy to remember. Is you can set this chart up and remember only the two blue arrows. Since there are only two possibilities, you know those two. The left side column is simply the balance sheet accounts, assets, liabilities and owner's equity, followed by the income statement accounts, revenues and expenses. Right? You can remember LOR. You can remember LOR is an acronym for all the accounts: assets, liabilities, owners, equities, revenues and expenses. Let's explain the rules of debit and credit in a very simple way, right? According to the equation we already discussed. Look at here. This is your balance sheet equation. Asset is equal to liabilities plus owner's equity. So asset at the time of increase debit, at the time of liabilities at the time of decrease debit, equity at the time of decrease debit, revenues at the time of decrease debit, while expenses at the time of increase will be debited. Then in another way, look at asset at the time of decrease, all the asset accounts are credited, while clubbing the liability, owners, equity and revenue, these three accounts are at the time of increase credited, because by nature they have credit balance. And expenses at the time of decrease are when paid off, they are credited. Right? So these rules must be kept in mind before recording any business transaction in journal. The transaction analysis. Transactions are to be analyzed very curiously for recording in journal. The 5 steps to analyze each transaction. Step number 1, determine which accounts are affected. Example, cash accounts, payable, rent, expense. At transaction always affect at least 2 accounts. So at the time of recording, you should look at your transaction, you should look at your business transaction, like what are the 2 accounts involved. Step number 2, determine which categories the accounts belong to. Right? If you determine the accounts in your financial transaction, then also determine to which category they belong to which category they are related to, whether they are assets, whether they are liabilities, they are capital, they are withdrawals, revenues or expenses. And step number 3, determine whether the accounts increase or decrease. Yes, this is quite necessary for you at the time of analyzing your business transaction to determine the specific increase or decrease in the business accounts. Example, if you receive cash, that account increases. If you pay cash, that account decreases. Step number 4, what do the rules of debit and credit say? Right? Then apply the rules of debit and credit that you already memorized, that you already in your mind. Already you have in your mind the rules. As per the rules, apply that rule to your financial transaction. And step number 5, what does the T account look like? The T account means the ledger account. Place amounts into accounts either on the left or the right side depending on the rules. So these 5 steps, on the scale of 5 questions, you should ask these questions from your own self at the time of analyzing a business transaction. Steps in the accounting process: journalize the business transaction, use source documents to record journal entry in general journal, right? Decide on accounts that are affected, then enter the date. At the very first you will enter the date, then don't indent the debit entry, right? Indent the credit. So it means that you will record the debit entry at the very extreme margin, right? And you will indent an inch or half an inch the credit entry, right, in the journal. Write description. Description is necessary. Write a brief description. Add a brief description to your transaction, or simply you should say whatever you are going to record. Debits and credits are the two columns. So the total 5 columns are to be dealt in journal. The debits and the credits are the 2 columns. Post all the journal entries to the ledger accounts in general journal. Right. This step comes after completion of the journal. The day book, when it is done, when you record all the transaction in journal, then you should post the transactions to the ledger accounts one by one. All the business same class accounts, same class business accounts are to be clubbed in a separate one account. For example, the building will have a separate account, the cash, the revenues, the expenses, owner's equity, payables, receivables, all these will separately be dealt and will separately be recorded in ledger accounts. Transfer the date. Again, you will be mentioning the same date, you will be mentioning the same amount, and you will record both the cross references. Transfer all totals to the trial balance. Then after that you will prepare the trial balance. What is general journal? This the book in which a person enters the original record of a business transaction. The original day book, right? The original book of first entry, commonly referred to as book of original entry. Chronological listing mean date wise. The chronological record mean chronological listing of all the business transactions for the company, right, date wise. Each listing records the debits and credits associated with that business transaction, right? It means that your debit must have a corresponding credit and your credit must have a corresponding debit. Means all the debits, whether the debits in split or the credit in split, they must be equal, right? There must be equality of every debit whether it's every credit, and every credit whether it's every debit. A book or location on a hard drive where all business transactions are listed, like a diary. What is a journal entry? Date, at least one debit entry. Debit account, use exact account title, don't indent the titles. At least one credit entry, right? Credit account, use exact account title, indent the titles. The credit entry will be indented. The debit entry will be recorded with the extreme margin of the format and a little bit indented. The titles of the credit accounts are to be recorded. An explanation of the transaction is necessary. A very good and small explanation with your transaction, it is necessary. Your transaction must be followed by a small explanation in order to tell the reader or to the auditor what you are going to record in your journal. Check number. Invoice numbers are necessary. Accounts receivable, customer name is necessary, right? Whom you are dealing. Many other elements. Remember, the accountant must leave a good audit trail so that users of accounting information can understand what occurred with each transaction. It means that your transaction must be very comprehensive in order to tell the auditor as well as to the general public, so that they might not have any sort of confusion by looking at your financial data or by looking at your accounting records. Your accounting records are worth to be checked by some general public or by the auditors, or to prove your authenticity you must follow the GAAP rule, the generally accepted accounting principles that I have discussed in the previous lecture in detail. According to those principles, you must record your journal entries. Debits must always be equal to the credit. Look at the example of business transaction recorded in a general journal. Look at this format. This is the proper format and this is the example in front of you. Look at here, you will be entering the date 1, 2, 3, 4, 5. A total 5 columns. Page number is necessary. Your heading is necessary. General journal, because generally you would be recording all the necessary transactions, right? It is a mix of the transactions. This statement will cover different transactions which are then split, which are then transferred one by one to its corresponding accounts. So the date is necessary. For example, 20th June, right? This is transaction number 1. Your cash is here recorded with the extreme margin. As I told you previously, that with the extreme margin you would be recording the cash or the first account. Then the second entry, that is the LP ARC capital, original investment by the ARC in ARC copy company. The amounts, this is the post reference column, right? This is optional, right? For companies it is necessary, but with academic perspective this column is optional. Look at the debit column. Here you will be recording the debit amount, which is $70,000, right? This amount or this column is used for pesas, right, or cents. Now look at the credit column, right? 70,000 would be equal to the debit and debit will be equal to the credit. This is the description. Original investment by the ARC and ARC copy co. This is the description, right? Skip a line between the entries in your homework, right? This one line is to be skipped so that your transactions are to be understood very separately, so that you can separately record the second transaction, right? For example, here in the first transaction cash is debited and the capital is credited. It means that this is the initial investment by the owner. Here we debited equipment and we credited cash, and we wrote a simple description: bought equipment for cash, right? $33,000, right? This is the format of the journal, a simple format, and in this form you will be recording different transactions. Create a journal entry for each transaction. How? Definition: ledger accounts, complete listing of business transactions for an individual account, where ledger accounts is so many times I discussed that this is the classified record of your business transaction, which is called, in technical terms we call it ledger, which is the second step after journalizing, where you look if you want to find the balances of any given account. Here in ledger accounts we are determining the net balance. General ledger, right? A loosely book or a computer file containing all the ledger accounts, right? Each account from the chart of accounts has its own ledger account in the general ledger. What is chart of accounts? A chart of account is the list of those accounts which are commonly to be used in your business accounts, and from time to time in a computerized account you will go to your chart of account and you will pick up your specific account by debiting a certain account or by crediting a certain account, right? So you will pick all your accounts from your chart of accounts. This chart of accounts is to be developed at the very first stage of starting your recording. Posting, the process of transferring figures from the journal to the ledger accounts is called posting. 4-step posting process: transfer transaction date to accounts column, transfer the debit credit amounts and calculate the new balance, write journal page number in post reference column of the ledger as a cross reference, right? This number is necessary for cross referencing, right? We write the page number of ledger in journal and we write the page number of journal in ledger for cross referencing and for connecting the two accounts that you have dealt in both the statements. Go back to journal and write account number in posting reference column of the journal as a cross reference. This is normal practice, and this cross referencing is necessary as a ledger folio. Cross reference the ledger accounts number in the post reference column of the journal and the journal page number in the post reference column of the ledger account. Look at the ledger accounts for the two transactions that we have dealt in the journal. A transaction was normally recorded first in journal, then posted to the ledger. What was the transaction? look at the top of the page. Arc deposited $70,000 in bank account in the name of business. Here we simply debited the cash, the proper date, right? Then the LP arc. The LP arc is the name of the investor, the name of the owner, capital. And this is the reference, post reference, right? This is the amount on the debit side, $70,000 on the credit side. Both the accounts are increasing, right? As per the analysis of the transaction, the cash account is also increasing, a capital account is also increasing. Both are increased, but according to the rules of debit and credit, one account is capital account, so as a result of the rules applicability, capital is credited and cash is debited. Now look at this page number that would be recorded here. Look at the date which is brought down, right, in the same manner. This amount, look at this amount, this is taken from the debit side, right, and recorded on the debit side, because here this amount is debited, so you would be recording as well on the debit side. Here you will write the, right, this is the cash title, you will write the account cash, because for cash you will be preparing a separate account, for capital you will be preparing a separate account, right? Again, this number is to be mentioned here, right? This is the page number, and all these are clubbed. And in step number 2, again you will write the balance, right? The balance is, it is recorded on the debit side, therefore your balance will be recorded on the debit side. Number 1, date of transaction. Number 2, amount of transaction. Number 3, page number of the journal. Number 4, ledger account number. These are the summarized key points which are step by step to be recorded. Look at the further analysis. Arc deposited 70,000, right? This ledger account, again, now you are preparing the capital account, so you will write account as LPR capital. Again, here the account for LPR capital is recorded on the credit side, so in the same manner you will bring it to the credit side, and the balance in the same manner will be recorded on the credit of the balance column, right? This is the preparation of the trial balance. How you will be preparing the trial balance? You will be preparing the trial balance by first putting the name of the company. This is the name of the company in centralized format. This is the name of the statement, trial balance, and a proper date. These accounts, look at these accounts, sequentially these accounts are to be recorded, right? Cash accounts payable, prepaid insurance, equipments, right? These are the cash accounts payable, prepaid insurance. These are the current assets. So you will first record the current assets. Then you will record the fixed asset. Then you will record the current liabilities. Then capital, right? Then revenues, and last the expenses, right? Cash having a debit balance, you will record the balance here in debit column. Then accounts receivable debit, your prepaid insurance debit, your equipments debit. Then the payables, which is to be considered as liability account, current liability, will be recorded on the credit side, the capital on the credit side. Again, the drawings, which is an expense for the owner, capital, right, on the debit side. Then income from services, revenue account. Revenue accounts are to be recorded on the credit side, and all expenses, look at all the expenses, the wages expense, the rent expense, the supplies expense, advertising expense, utilities expense, right, will be recorded on the debit side. And at the end, both the sides, the debit side, right, total, and the credit side total, they must be equal. If these two sides are equal, it means your accounting procedure is correct. Your accounting cycle, your procedure of recording business transactions, that is correct. Otherwise, if they are not being tallied, if they are not being equal, you should go back and you should find out the reasons, the errors in the accounts, like where you have done a mistake, and then you will go and you will rectify. left column the debit and right column the credit. Trial balance proves debit must be equal to the credit. Thank you so much.